Welcome to Prime Stream, brought to you by the Independent Intelligence Alliance. Today we're doing a deep dive into their latest research on, well, gold.
Yeah, told.
And specifically how bizarrely it's been acting since the West Asian conflict kicked off on February 28th, 2026. Okay, let's unpack this because there is this massive paradox right now.
It really is, yeah.
Right, like you'd think global crisis hits, gold shoots up. It jumped, what, like 10% after the 2022 Ukraine invasion? But right now, over in India, 24-karat gold just totally tanked from about 1.9 lakh rupees down to 1.3 lakh.
Which is a huge, 30% drop.
Exactly. It's like deploying an emergency parachute only to find out it's an anvil just dragging you down.
I actually, I love that anvil analogy because it perfectly gets at the mechanics here. We always treat gold like this, static, unbreakable shield. But modern markets mean that when a specific sequence of dominoes starts falling, well, that shield just gets liquidated. And the first domino wasn't even gold at all, it was oil.
Oh, right, because the conflict immediately shot oil prices way past $120 a barrel.
Exactly. Which completely terrified the markets. I mean, oil at $120 means literally everything costs more to produce and ship.
Which sparks massive global inflation fears.
Right. And so central banks step in. They have to keep interest rates high to try and cool the economy down.
Wait, hold on a second. I get how high interest rates cool down borrowing for, like, mortgages or corporate loans, but how does that actually hurt a physical asset like gold? I mean, it is literally just metal sitting in a vault.
Well, the fact that it just sits there is the exact vulnerability. Gold pays no interest.
Ah, right.
Yeah, it doesn't generate a yield. So when interest rates stay high, yield-bearing assets, like U.S. government bonds, become incredibly attractive. If you're an investor, you suddenly have this choice. Hold a shiny rock that pays you nothing, or hold a government bond that gives you a steady, guaranteed payout. Capital is naturally going to flow toward the yield.
Which means all that global capital rushes straight toward U.S. bonds. And, well, to buy those bonds, you need U.S. dollars.
What's fascinating here is how that rush for dollars completely alters global currency dynamics. As investors scramble to buy up dollars, the U.S. currency strengthens massively. But since gold is priced globally in dollars, a stronger dollar suddenly makes gold way more expensive for buyers using euros or yen or rupees.
So international demand just totally evaporates.
Completely evaporates, yeah.
And this is where the timing really backfires. Because right before this conflict broke out, gold had just hit these insane record highs.
Oh, yeah, over $5,000 an ounce internationally.
Right. So the moment international demand dropped and the price dipped even slightly, the bots took over.
Exactly. Modern markets are, heavily automated. That initial little price dip hit the thresholds for algorithmic trading bots. They just automatically generated these massive sell orders and started dumping gold blindly.
Oh, wow. And it gets even worse because equity markets were completely tanking at the exact same time. Like, if you were an investor bleeding cash in the stock market, your broker is issuing a margin call.
Yep. They demand cash immediately to cover your trades.
Right. So if you don't have the cash on hand, you are basically forced to sell whatever liquid asset you have that is currently profitable, which right now is your gold.
That is the core of it. We call that a liquidity crunch. You aren't selling gold because you think it's a bad investment. You are selling it because it is literally the only thing you can sell to get cash quickly.
Yeah.
It becomes this vicious cycle of forced selling.
Okay, but wait. If retail investors and all these algorithms are blindly dumping tons of gold, someone has to be on the other side of those trades. If everyday investors are broke, who has pockets deep enough to buy that much physical metal? Is it central banks?
Oh, absolutely. They are quietly scooping it all up at a massive discount. I mean, the U.S. dollar might be strong right now, but its actual share of global reserves has dropped significantly.
Right, from what, like 71% in the early 2000s?
Yeah, down to below 60% recently. So central banks are aggressively buying physical gold to diversify.
Because of the geopolitics of it all. Like, we saw Russian financial assets get frozen by Western allies back in 2022. If you just hold digital dollars, another country can essentially just freeze your national bank account.
And that is the crucial difference. Physical gold, stored away in your own sovereign vault, has zero counterparty risk. No foreign government can freeze a physical brick of metal. It is basically the ultimate geopolitical hedge.
So what does this all mean? Ultimately, this massive crash we are seeing isn't the death of gold. It is just a temporary liquidity adjustment, like an algorithmic chain reaction driven by an oil shock.
Exactly. The fundamental long-term value of the asset hasn't changed at all, just the immediate market mechanics. It is a stark reminder that no asset exists in a vacuum. A spike in oil changes interest rates, which changes the dollar, which triggers an algorithm, which forces you to sell your gold. Everything is completely interconnected.
Which leaves us with a pretty wild thought to chew on for today. If a single physical commodity, like a barrel of oil, can completely invert the behavior of humanity's oldest financial safe haven, what unseen vulnerabilities might exist in the modern, purely digital wealth reserves you and I trust today?
That is a very good question to ask yourself.
Next time you look at your portfolio, definitely ask yourself if your parachute is actually an anvil in disguise. Thank you so much for joining us on Prime Stream today. Please make sure to share and follow the show so you never miss a deep dive. Catch you next time.